Welcome. My name is Mark Gonzalez, and together with Kimberly Ramos, we are your virtual hosts for today's presentation. Also with us today in the background for technical support is Brandon Cowley from the Cisco WebEx team. In just a moment, our wealth management investment experts will share their new year investment commentary with you. The presentation will last approximately 45 minutes, at which time they will answer questions from the audience. If you would like to ask the panelists a question, please use the Q&A feature at the bottom of your screen. We will collect your questions and present them to the panelists at the end of the presentation. If you experience technical difficulties during the session, please dial 1-866-779-3239, or you can message us using the Q&A function. During the presentation, all participants will remain in listen-only mode, and as a reminder, this event is being recorded for rebroadcast. Now, please welcome David Wissinger, Senior Vice President and Senior Portfolio Manager for Mechanics Bank. David.
Thank you, Mark, and thank you everyone for joining the presentation. We're glad you're with us today. To start, I would like to introduce all of our presenters. First, we'll hear from Todd McGinley, who will talk about the economy and what we see coming in that area. I'll talk about stocks and bonds, those markets. Alexandra Hagan will introduce the concept of ESG investing. And then Ricardo Calderon will discuss cryptocurrencies and the overall topic of valuation. So with that, Todd, will you start us off, please?
Thanks, David. Happy to. Welcome, everybody. I'm going to cover the topic of macroeconomics. And just as a brief apology for the sound of the chainsaws in the background, you can tell I'm in the forest. So the economy is characterized as being one that's slowing down. You can see from this chart of quarterly GDP growth that we're about at 0% growth, but I think that that's important to be put into proper context. And the context I'd like to leave you with is that growth is normalizing. So if you look back to the pre-pandemic period of time, you can see that growth was about 2%. That was about the normalized rate of growth for our economy. And then during the pandemic, we had the self-imposed drastic recession that sent our economy down 40+%. And then when the lockdowns eased, we saw a recovery that was just as dramatic as the decline was. Although, of course, a lot of people were put out of work. Once the economy opened back up, we were able to get the economy going again to a large degree. But really, we've been recovering from that lockdown ever since. And you can see from the chart that last year in 2021, economic growth was about 5.5%. The reason that we're getting down to something around 0% right at the moment is kind of a multitude of factors, but they're all relating to the end of the pandemic. We had the Omicron variant, of course, and that created a certain amount of slowing, but not a whole lot. We're seeing supply chain disruptions. We've all heard about the automobile industry and the difficulty that they're having producing vehicles. I was at a dealership recently and they only had 5 vehicles on the lot and 2 of them were used. Also, employment. Employment is recovering nicely, but we're having businesses and employers all over the country screaming for employees. They want to grow their businesses. They want to capture the opportunity to serve customers, and to do that, they need employees, and they're hard to find. Right at the moment, we have 4 million unfilled job postings that are out there, and that's 4 million more, to be specific, than the number of unemployed people. And the number of unemployed people itself has gotten back to the level of the pre-pandemic. You can see on this chart here that prior to the pandemic, we were running about 3.7% unemployment. And then we, had a whopping 15% unemployment briefly, and that we've been recovering ever since then. And so now we're down at 3.9%, which is really good, but it doesn't equate apples to apples to the pre-pandemic period of time, because we have lost an awful lot of people out of the labor force. Baby boomers have chosen to retire. There's a number of people who found that they liked working from home, that they could do just as good of a job working from home, maybe being a self-employed individual. So the official employment statistics suggests that we've got about 3 million fewer people employed now than we did pre-pandemic. I don't think that's really the case. I think that those 3 million people are, for the most part, probably working. They're just not being captured by the statistics. Certainly a lot of baby boomers have decided to go ahead and retire, and they are, in fact, out of the labor force. But we did see in January 1 million new people, well, 1 million people were added. I don't know if they were new or not. 1 million people were added to the labor force in January, 2/3 of them being women. And so, having the schools open, having the daycare centers be open really helped out with that. Plus, what we're seeing is that these businesses that are desperate for employees are increasing their wages that they're offering. I think I saw somebody advertising $19 an hour for a regular hourly minimum wage type job. So we're seeing a lot of pressure on wages, and what that's doing is it's causing a lot of churn. People that were in a previous job, maybe making a lower wage, are taking this opportunity to transition to a higher wage job. And so we're seeing the number of quits really, really accelerate. So it was a record number of quits, people quitting their jobs in January. And those aren't just people leaving the workforce, they're changing jobs. They're taking this as an opportunity to step up and get a job with maybe higher mobility. So even though we're seeing the economy slow to something like 0% at the current quarter, this is a level of hiring and employment activity that is consistent with a much stronger economy. So, we think that the 0% growth rate, or maybe 0.5% growth rate for the current quarter, really is just kind of an artifact of, higher inflation and, some temporary disruptions. One of the things that you'll see on the next slide is that inflation has really stepped up. Inflation for the last 30 years has been, under 2%. The Fed's been super frustrated trying to get the inflation rate up to 2% and just was not succeeding. Well, lo and behold, all we needed apparently was a pandemic, and now we've got inflation that's well above 2%. It was 6% for the most recent year. And this reflects two important factors. One is the supply chain shortages, so the cost of everything, shipping, production, semiconductors, everything's gone up. Try getting a deal at that dealership. They weren't making any kind of a deal at the dealership. And wages. Wages are not going down. Though they're going up, they're not coming back down. The prices of goods, such as cars and cereals and energy, those all go back down as soon as the supply and the demand situation equalizes. So we'll see that the inflation rate is going to moderate from really an unsustainable level right at the moment down to something like 4% or maybe 3%. In the next year, so 4% for 2022, 3% for 2023. Plus, we've seen that the Federal Reserve feels that this situation is very intolerable. The Federal Reserve cares about two things: employment, check, we've got employment taken care of, and inflation. Inflation is a problem right at the moment. So the Fed is transitioning from supporting the economy, supporting employment, to fighting inflation. And that's going to be the next phase. And so we'll see them most likely increase interest rates in March, and we're going to see them start to reduce the size of their balance sheet. And so they're going to start fighting inflation, and they have a very good track record of doing that. We don't expect interest rates to themselves be a huge problem. I mean, interest rates right at the moment, the 10 years only 1.7, 1.9. So that's not an obstacle for a lot of businesses. That is going to slow down mortgage refinancing to some degree. But in summary, the important things to take away is that employment is low, that we are missing a lot of workers, but the employment situation is improving. Those workers that are interested in working are coming back to the labor force. Inflation is really high, but it is going to decline. I'm not going to use the word transitory, but inflation is going to be moving back in the direction that we would want it to move in. Growth is slowing, but it is going to be positive this year, and so it's in the process of normalizing to sort of a post-pandemic world. And like I mentioned, interest rates are not going to be a problem. So I hear the chainsaws are back. At this point, I will turn it over to David to talk about the stocks and bonds.
Okay, thank you, Todd. In looking at stocks to see what we expect in the next couple of years, I'm going to start with a longer-term view. This first slide shows a long-term chart of the S&P 500. In fact, it goes all the way back to 1945. So this is the entire post-war period. Those shaded areas, if you look at this as like a timeline, those shaded areas are periods of economic recession. And moving along the timeline, you can find periods where stocks declined in price, sometimes kind of dramatically. You can also find periods of time where stocks move sideways in a choppy, kind of volatile way. But the thing you can't help but take away from this slide is that stocks go up. Even the shortest glimpse of this slide would impress you, I think, with the upward momentum of the stock market. This is something you'd probably say, I want to be involved in that, whatever it is. So any conversation we have about the short-term view of the stock market really has to be framed in the long-term view, which is that stocks are moving upward. So the next slide gives us a slightly different view of the S&P 500. And this shows annual returns for each and every year since 1950. So this is 72 years of S&P 500 annual performance. In only 15 of those years did the S&P 500 deliver a negative return. Conversely, 79% of the time, the S&P 500 was positive by the end of the year. Now, I don't know if either the Bengals or the Rams have a 79% chance of winning the Super Bowl on Sunday. I suspect that they do not. But if one of them did, that would look like a pretty sure bet. So thinking in terms of the S&P 500 being positive 79% of the time, you can see that being a long-term investor in stocks is a pretty good way to ensure success in investing. So looking at the next slide, we'll try to take a view of what's going to happen in the short term. And we'll start by looking at valuation as the price-earnings ratio of the market is measured. So what this chart shows us is each one of those dots on the chart is an annual return dot for the S&P 500, but correlated to a price-earnings ratio for the market. And what you'll see is that trend line down the middle is showing us that the lower the PE ratio for the market overall, the higher the potential return. The lower the PE ratio for the market overall, the lower the potential return. I think I said that right, but you get the point. Mark, if you could point to that intersection for me there. Yeah, that's it. So at the end of 2021, the PE ratio for the S&P 500 was just shy of 24 times earnings. So we find that spot on the chart, and we see that for the foreseeable future, we'd expect the S&P 500 to return about 6.25% or so, something like that. So this is less than what we've seen in the last few years, but still looking at a positive return. On the next slide, we can look at a little different view of how we might look ahead. Todd talked about inflation, and we're going to look at this slide one more time because I want to remind you that the Fed's job is to keep inflation at 2%, and we've barely had that in the last few years. In fact, in the second quarter of 2020, we had negative inflation or deflation, and that was due to the first time ever abrupt stop of economic activity. People stopped spending literally overnight. And so prices dropped. But then as we began to have a recovery that has been a little bit stop and go, but still inflation is back. So the Fed's going to take some action to reduce this higher level of inflation. They're going to raise interest rates and reduce liquidity in the economy. So by the end of the year, we see that inflation should be coming back down a little bit to maybe the roughly 4.5% range, or maybe a little bit lower. So considering inflation and its effect on stocks, the next slide will show us how that works. A lot of bar charts here, but the one I want you to look at is the one on the lower right-hand corner. And if you look in the far right, you'll see that with inflation at 4.5% or more, history would tell us that stocks will return about 3.5%. If you look back to the left-hand side of the chart, the second bar from the left, where we had much lower inflation, you see double-digit returns, and we had those for many years while inflation was low. But with inflation running a little bit higher, we're expecting lower returns. So in the next few years, considering valuations and inflation, maybe we can expect stocks to be anywhere from 3.5 to 6 or maybe even 7% annualized. I know that's kind of a wide range, but we're predicting the future here, so we need a little bit of wiggle room in that. And then moving on to the next slide. One way to kind of be sure that you have better returns in your portfolio is to reach for diversification. This chart shows different subclasses of the market. In fact, there's 13 of them, and how they vary in return from year to year, depending on what pressures and other things are acting on the stock market. And it's different every year. So some years, one asset class will be at the top, and the next year or a couple of years later, it could be at the bottom again. But if you take a look at that column over on the far right, where it lists all the different subclasses that we're talking about right in the middle in gray is balanced. And that's representing a portfolio of stocks and bonds, including many of these subclasses that we see here on this chart. And over a 10-year period, that balanced portfolio has produced a 9.7% annualized return. And that's pretty good. You'll also notice that the balanced number is never at the top of the chart, never the best performer in any given year, but it's never the worst either. So a balanced portfolio delivering 9.7% for most people is kind of the way to go. So that's something to keep in mind as we move forward into a period where there'll be more volatility with stocks and slightly lower returns than what we've seen in the past few years. Okay, Mark, let's move on to the next slide. Looking at bonds, just briefly, this is a chart of the 10-year Treasury going back to 1990, so 30 plus years. What you'll see from this chart is that we've had a long period of declining interest rates. And in fact, that period is even about 10 years longer. I think rates peaked maybe in the early 80s, about 1983, and have been come down steadily since then. We had a dramatic decline in the 10-year yield during the pandemic. In fact, it hit an all-time low yield of 0.5%. in the early part of 2020, but it's come back. It's come back mainly because the Fed is broadcasting its intent to raise rates. So the stock or the bond market is reacting to that, and rates are coming up in advance of that. This will create a little bit of a headwind for stocks, but on the other hand, it will also create an opportunity to look at stocks or bonds that is a more attractive investment. And we have not really had that situation probably for the last, I don't know, 5 or 10 years, where you could look at maybe a 5-year corporate bond and see a yield that was attractive that you wanted to buy. So maybe a little headwind for stocks here, but also a new opportunity to add to some fixed income part of the portfolio. And then I think to wrap up in the next slide, the Fed is changing the landscape for the stock and bond markets with higher rates and less liquidity. So that's something that we see happening already with more volatility in stocks. Going forward, we'll probably see some lower stock returns in the near future. Maybe more emphasis on value stocks and less on growth stocks. And again, we've seen that so far this year in the stock market. Earnings reports will probably be more important than ever, important as they always are. And then short-term rates, probably at least 1% or higher by the end of 2022, which will also go all through the yield curve, as we saw in the 10-year bond already rising. So with that review and look forward of the stock and bond markets, I'm going to turn our presentation over to Alexandra, who will talk about ESG investing.
So today I'm going to discuss ESG investing. And ESG investing is an approach to investing that considers environmental, social, and governance issues when you're making these decisions in your investing. And they help us determine a company's financial health and their future growth potential. Companies today face a lot of different ESG-related risks, including ones related to climate change, of course, also how employees are treated at their firms, and how businesses are run. So by incorporating all this data into traditional investment analysis, we have an additional toolkit that can help us identify those companies that are building long-term competitive advantages and avoid companies that are not trying to minimize ESG risks, which could potentially enhance investment outcomes. So ESG stands for environmental, social, and governance, as I said. The E represents such factors that would contribute to climate change, energy efficiency, pollution. Companies with higher ratings in this sphere are more likely to have good environmental operational procedures. The S stands for social factors, including working conditions, diversity, and safety. Companies with higher ratings in this area typically have more friendly work policies, making it easier to attract and retain talent. Also, good employment policies reduce the risk of lawsuits, and the big one, reduce the risk of reputational damage to the brand. The G refers to governance. Strong and transparent corporate governance reduces the risk of unethical practices that could damage profitability and stock performance. For example, companies with a diverse and independent board of directors may more effectively manage risk. On the next slide, I go into the different types of investment that can be made in this ESG investing. There are several different approaches to consider when designing an investment strategy that is ESG minded. These can be used separately or combined to design portfolios. So first, there's an exclusionary method, and this is probably the most common or the method that you might think of when you think of ESG investing. This is also the oldest method. It's basically just excluding certain stocks or certain investments from a portfolio, like tobacco, firearms, gambling. An alternative, a more modern screening approach, is looking for positive ESG indicators or investments in best-in-class companies. So those that are leaders in key issues compared to their peers. So for example, you could be investing in an energy or utility company and have an ESG mind because you could be focused on those that look to innovate in renewable energy or operations that are less water intensive, for example. Thematic investing emphasizes broad ESG themes such as low carbon initiatives, gender equality, or clean technologies. And impact investing seeks to deliver a measurable social or environmental impact in addition to a financial return. In order to determine what rates high or what rates well on an ESG screening, there are different companies that assist with all these determinations and publish many different resources and grade companies on these factors. So what can be an ESG investment? On the next slide, you can see that while you can and while most of the money is directed to active equity and active fixed income or bonds, infrastructure, real estate, commodities, these all can be considered ESG investing depending on what type of security you invest in, and they all can fall under the umbrella of ESG investing. So here at the bank, on the next slide, you can see that we do have an option for those investors who are interested in ESG investing. Our approach includes a full portfolio made up of ETFs, electronically traded funds, as well as you could also work with your portfolio manager to select investments that suit your values. We do use the best-in-class method to construct our ETF portfolio. Best-in-class can be more effective as it reduces tracking error. So that's the difference between a more traditional benchmark and the ETF ESG portfolio. And it can be more effective overall as it actively involves company management in order to affect change. Our approach also includes thematic and impact investing funds, like a fund focused on clean energy. So the big question, of course, is, am I going to achieve comparable returns if I'm investing in ESG investments? A recent study by Morgan Stanley analyzed the performance of sustainable funds from 2004 to 2018. And again, ESG investing is a more modern idea. So we don't have the decades of history to look back on, but we have been, they have been at this for a while, so we do have a few years to measure. And this study found that sustainable funds provided returns in line with comparable traditional funds while reducing downside risk. The study also found strong statistical evidence that during a recent period of extreme volatility, for example, the Great Recession, sustainable funds seem to be more stable. Of course, by design, individual companies that incorporate ESG principles into their long-term investment strategies also end up avoiding short-term profit motivations and focus instead on creating value opportunities over time. Overall, this reduces risk to shareholders and provides more opportunity for positive returns for companies. A study showed that when a company takes into consideration their environmental impact, their social philosophy, and governance controls, the majority of the time it leads to a positive financial performance for the firm relative to a broad market index or a benchmark. Investors in these companies have the potential to see their investments at least perform in line with the broader stock market, if not better, like we saw recently in the 2020 financial crisis. Now, looking ahead into 2022 and beyond, what is going to happen in this world of ESG investing? And the overall theme for ESG investing is doing more. So carbon neutral is not enough. Transparency is not enough. Just divestment is not enough. For example, shareholder activism increased in 2021, including voting against directors of companies for a lack of credible climate action plans. This is only poised to grow in the 2022 proxy voting season and beyond. ESG investing is becoming a more active way of getting involved. Instead of just choosing to not invest in certain industries, money is now being funneled away from those industries and into industries that are making positive change, making actionable change. Social issues is also a big focus for 2022. Government and corporate leaders are under pressure to strengthen their ESG skills and really focus on the S. The E has always really been a big focus and probably what a lot of people think of when they think of ESG. But the E and the S really need to work in tandem as we see climate-related issues starting to cause social-related issues. For example, efforts to promote the low-carbon economy could be disrupted in the absence of credible plans to promote the economic and the social side. So in the climate conference in Glasgow, COP26 in November of last year, more than 30 countries signed pledges to support workers and communities who might be hurt by the transition to a green economy. This past year has also shown us how much supply chain issues can disrupt our life. So as we try to build back from the breakdown in the supply chain, we can now focus on billing it back in a socially responsible way. Big companies will have to respond to human rights issues and labor practices both abroad and at home as they build back their supply chain if they want to build back resiliently. Like financial stress tests that were imposed on banks in the wake of the 2008 financial crisis, companies may now have to engage in climate stress tests to determine their readiness for climate disaster-related issues. And overall, all of these ideas, all of this focus on more action is really going to address the concept of greenwashing. So there's been criticism of ESG investing that people are just taking money and greenwashing it and just saying they're investing in ESG investments, but not really adding any value. It's the idea that this is a trend and people are just jumping on this bandwagon without regard for actual change. So now the focus turns into ESG investing is already an established concept, and the future of it is to focus money and effort into those actions which will actually make the world a better place. And with that, I will now turn it to Ricardo to talk about asset valuation and cryptocurrencies.
Thank you so much, Alexandra, for that very timely presentation. Good afternoon, ladies and gentlemen. The last 2 years have been an incredibly interesting period of time for everybody, from teenagers to adults, investment professionals, attorneys, everybody. During that period of time, our team has fielded multiple questions as investors have been paying particular attention to the rise of cryptocurrencies, and in particular Bitcoin, since that does tend to take the most attention in the marketplace. So we thought that today might be a good day to give everybody an idea as to what our team is thinking about cryptocurrencies, but through the lens of asset valuation, because our team has been quite consistent in our responses to our clients as well as any other people that we might be advising, including our colleagues, about cryptocurrencies. So we thought that today we'd take that time to look at asset valuation and cryptocurrency and the conundrums that it presents. Let's move on to the next slide. I guess starting off though, some people might think, what is valuation? I think it's important for everyone to understand that when we are creating investment portfolios for our clients, that this is not a willy-nilly process, that it is not a game of roulette. We don't just walk by the table and put money down on anything that that looks okay. There is a process in place. There's a methodology for valuing stocks, bonds, real estate, and currencies. And we want to ensure to our clients that there is a process that is used as we look to create these theoretical values. Why? Because these theoretical values are an important part of the decision process. You're going to see on the next page. These theoretical values are actually used by investment professionals, including our team, to determine entry points and exit points for our positions in client portfolios. What the team does is that we use multiple factors that I'll be reviewing on the next slide. We use multiple factors to determine the value of a particular security, whether it be a stock or a bond, at any given point in time in the market. We look to determine the current present value, but we also like to get an idea as to where might this value go. And we look at other research to help us determine where might this value be in a 1 year, 2 year, 3 year, 5 year period of time, to determine, should we be entering this asset now, or should we be exiting this asset at this time? Obviously, as this chart points out, we would be looking to buy securities that we believe to be undervalued at this time, or possibly, conversely, selling those securities that are held in client portfolios that we do believe to be fairly valued or overvalued at this time, especially if we do believe that this is probably going to be the best time to be exiting those positions. If we go on to the next page, you'll see some of the factors that go into determining value. This is quite a long list of factors that are listed here. Very importantly, though, I think what we want to take a look at here are expectations. On the lower left-hand corner, expectations of cash flows, expectations of revenues, and expectations of profits. So, that's, especially profits, that's going to really help us determine, is this going to be a good investment for the next period of time, whether it be a 3 or 5 year period of time or not? or should we be looking at cash flows? And there are many companies that, especially in the small cap and in the tech world, that they may not be generating profits right now, but they can forecast when profits are going to be start to exist in the company. And we can also see how that company is growing, how their cash flows are growing, how their revenues are growing. And a very important consideration here is what we call the second derivative of that growth. How fast are those numbers growing? Because that's also going to help us determine what kind of valuation that company deserves to have. Other factors that are incredibly important in determining the value of any given asset is the current interest rate environment. Are interest rates rising or are interest rates falling? That's definitely going to help impact the value of an asset. What's the current and future economic environment? Are we going into a recession? Are we coming out of recession and going into an expansion in the general economy? That's also going to help us determine what the value is of a firm. Likewise, the industry sector, are we looking at firms in a more controlled environment like in the banking businesses or in the utility industry where the government regulates a lot of that business? Are we looking at a firm and valuing a firm that is in a less regulatory sensitive environment such as parts of technology or consumer discretionary firms? We always, of course, look at peers. What are the multiples like for the peers? What kind of earnings or multiples over earnings are the competitors getting to help determine what the value is? Most important, though, from this chart, you're seeing that there's a multitude of factors that go into the valuation process. And again, this is used by all investment professionals, whether it be somebody who's investing in a piece of commercial real estate, somebody who's investing in possibly taking a position in currencies around the world, somebody who's looking to devalue the stock of a company, and of course it also applies to fixed income or bond assets as well. Now, as we go on to the next slide, we're going to see how does this impact cryptocurrencies? Maybe a little bit of history might be helpful at this time. As we note here on this chart, cryptocurrencies really came into the fore about 10, 15 years ago or so as a response to some maybe possibly questionable activities that were taking place, not nefarious, but definitely questionable activities that were taking place in the late 1990s and early 2000s by central banks around the world. Central banks, including the government Japan, implemented these policies of quantitative easing and in a way to try to stabilize their economies or help their economies continue to grow. But some global investors thought, well, you're actually liquidating the value of your currency. Should this really be taking place? So cryptocurrencies arose as a solution to try and fix those problems that some people in the world saw that were taking place, these questionable strategies that central banks around the world were implementing to help prop up their economy and support the economic growth. These cryptocurrencies, as I mentioned, they were created as a response to these events. They were looking to really decentralize type of currency and create a new currency or a medium of exchange that cannot be easily manipulated by a government for its own purposes. Additionally, what they were looking to do is put the control of that currency or that medium of exchange back in the hands of the people who were using it. And they were looking to safeguard the value of that quote-unquote new medium of exchange using technology, creating and using encryption to help create and monitor and safely transfer the asset or the coin or the medium of exchange from one entity to another. That is a very basic general explanation of what a cryptocurrency was and is and why it even came into being. Again, in a response to some strategies that were being implemented by central banks around the world. At the bottom of this chart, I actually put there the price chart of Bitcoin. Again, Bitcoin is the most popular of the cryptocurrencies. We see that Bitcoin came out of nowhere and rose from several $100s per Bitcoin all the way up to a recent peak in November of this last year of $63,000 per Bitcoin. With that said, Bitcoin as of yesterday was trading at around $44,000. That is a lot of money. But an asset going from $63,000 per unit to $44,000 unit does not resemble any type of currency, nor is it any kind of medium of exchange, nor is it any kind of stable coinage. That, as far as we're concerned, reeks of speculation. The type of price swings that we see in cryptocurrencies, Bitcoin in particular, resembles more speculation than anything else. But now let's look at it from the lens of valuation. If we'll turn to the next slide, what are we looking at when we look to value a company, look to value a currency, look to value a bond? We're looking for earnings. We're looking for some kind of revenues to substantiate value. We're looking for, if we're looking at a currency around the world, we're looking at GDP. What is the general, what's the product of this nation? Whether it's the United States or Brazil or the UK, what can that country generate in growth to help substantiate the value of the currency that they are using? So as far as we are concerned, Bitcoin, nor do any of these other cryptocurrencies, they don't generate earnings, they don't generate revenues, they don't have any GDP to back them up. And without any of those factors, there are no forecasts. And if there are no forecasts, there is no fundamental value. As far as we're concerned, cryptocurrencies are nothing but an incredibly speculative play on fear in the marketplace. And when I say fear, I'm speaking of fear of missing out. As we note here, cryptocurrency investing, if you want to say that, cryptocurrency speculation is nothing more than a fear of missing out trade. People felt that they missed out on a party of an asset that went to a highly speculative bubble and blew up in value and continues to trade in a very speculative range. If we'll go to the next slide, in conclusion, I just want to confirm that there is a process in place when we are allocating assets and selecting investments on behalf of our clients in their portfolios, especially with our fiduciary responsibility that we have to our clients. We're beholden as fiduciaries. This is not a game of darts. This is not a game of roulette. There is a real methodology and a process in place. With that said, I know we have some time for some Q&A, and I'm going to turn it over to Kim Ramos as the moderator for our questions. I want to please keep in mind for any questions that you're looking to pose, please keep them germane to the presentation that you've heard here today. Any of your own individual investment portfolio questions, you might want to discuss those with your portfolio manager in a separate conversation. Kim?
Thank you, Ricardo. We do have some questions. Todd, someone asks, will the Federal Reserve's actions cause a recession?
Thanks, Kim. So the Federal Reserve has in the past caused recessions. They do not particularly want to do that. And so their goal in the current cycle and in the previous several cycles is to create a soft landing. And that is raise interest rates, slow the economy gradually and softly, inhibit inflation, and then return financial conditions to a normal level. So it's too early to say at this point whether the Fed is going to make a policy mistake. They are, in fact, perhaps a little bit behind the curve at the moment. They should have been raising interest rates already, and they should have stopped buying bonds several months prior to this. So they have a little catch-up to play. But I know that they want to be very sensitive and gentle when it comes to the economy, and they would want to use a recession only as a last resort.
Thank you. Dave, for you, considering what you said about the stock and bond markets, should we be changing our asset allocation?
That's a good question. I would say generally not. What we're seeing is maybe a slowdown in asset prices, not a crash or anything dramatic like that. So generally not, but I would also add that, and we say this all the time to our clients, that reevaluating asset allocation is kind of a ongoing project, that you should always be looking at your asset allocation to check and see if it still matches what you perceive to be your risk tolerance and also your time horizon. And so as those things change, your asset allocation ought to change with it. That's a little different than the question that was asked, but it's related, so I felt the need to say it. But for right now, absent any changes in those particular pictures, asset allocation is probably fine.
Thank you. Alexandra, how do you know that ESG investing is effective in what it claims to achieve?
So there's different ways to measure how, if a company is doing what it sets out to do. You can obviously confirm that a company is lowering its CO2 targets. You can confirm that a company is making its board diverse. And like I mentioned earlier in the presentation, there's companies that can do the work for us for this. So for example, MSCI is a company that will provide reports and provide different data. There's also, we use Morningstar here, and they provide sustainability ratings for each companies to see how a fund's holdings are managing their ESG risks and opportunities relative to peers in their category. So you can measure these kind of quantitative things, but the real question, I guess, is how if you can see how a company is, the outcomes, right? The outcomes and the impact of what they're doing. And that's a little bit harder to measure. It's always going to depend on what you set out to do, what your impact is, or what your values are and your priorities are. The field is relatively new in terms of, in comparison to the stock market, for instance. So it's something that's constantly evolving and changing. And once you determine what you want to see when you invest in ESG, then you can use that quantitative data and determine if the outcomes and the output is there from your investments.
Thank you. Ricardo, why do higher interest rates tend to decrease valuations?
Especially, this is a good question, especially in light of what's been taking place in the economy and especially in the stock market in the last month or so, where fears of the Federal Reserve acting in the next few months, possibly hiking rates to the tune of 50 basis points in the next few weeks in the month of March, and how that impacts valuations. Basically, it's in the theory of investing. The higher interest rates go, the less investors are going to be interested in stocks and the possible growth in stocks, and the more that they're going to be interested in the more sure, guaranteed rate of return from a fixed income asset. So in general, what you're going to see is capital flows moving out of some of the equity markets and going back to the bond markets and buying the yield that people can get in the fixed income market, thereby decreasing the value of the assets marginally, very marginally on the equity side of the portfolio. So again, it's more like, the way that the theory goes is that people are going to prefer the surety of the fixed income as yields start to rise.
Thank you. Todd, we just hit a new high with the national debt. How will that impact the economy as we go forward?
We've been actually hitting new highs with the national debt for a really long time, right? I mean, it's it's been since the Clinton administration, since we've had a balanced budget. So the fact that the debt is going up is not good. What it does was it takes resources away from the federal budget. The federal budget could use those resources to spend on defense or social programs, and instead they're spending it on paying interest. They can continue to do that really for quite some time because we do have control of our own currency. If you look at Japan, for example, Japan has twice the amount of debt per unit of GDP as the United States does, and they're able to continue on with their governmental programs just fine. We did see a few years ago in the European sovereign debt crisis problems in Portugal, Greece, potentially Italy, where these countries, they don't control their own currency, right? They're using the euro. And so they couldn't produce more euro, and they were potentially running out of currency to pay the interest that they owed, which would have been a really big problem. But we don't have that problem because we're using dollars and we can always just print more of them, which is an inflationary risk, of course, but it does give us the flexibility to avoid default. I think what the preferred method of debt reduction is for the government is for them to keep the federal budget, relatively steady, and then have the GDP continue to go up so that the debt becomes a smaller and smaller percentage of the overall economy, because it's hard to actually shrink the government budget, because whose ox are you going to gore, right? I mean, what are you going to take money away from? So, it's nice that the government can borrow and can support the economy in times of stress, and it is desirable for the government to cut back in good times, so that they still have dry powder for the next crisis.
Dave, if the current valuation of stocks means lower returns in the near future, what will have to happen for us to see higher returns?
Okay. Well, as you value stocks or the stock market overall using the PE ratio, which is price earnings, either price has to change or earnings have to change for valuations to change. So we might see prices of stocks decline somewhat as the economy slows down, as interest rates rise, as liquidity evaporates. But at the same time, given decent economic growth and good earnings reports going forward, so earnings rising, then those two actions could lower PE ratios, and stock valuations will pick up again. So it could be one, it could be the other, it could be both working together. My guess is it's going to be both working together going forward. But these things tend to go in cycles like that. Overvaluation, valuations come down, prices go up again, and that's kind of the cycle that we're in right now.
Okay, thank you for all those answers. That's all the questions we have, and I'll hand it back over to Mark to conclude.
Thank you, Kimberly, and thank you, panelists, for your informative presentation. And we want to thank everyone who's joined us today. We really appreciate your time. If you have any questions, please feel free to call Mechanics Bank Wealth Management at 800-781-3441. And thank you and have a great day.